There is a real change. It took effect on the 4th of May, 2026. It is written down in an SSA emergency message numbered EM-25046 REV, and it is almost nothing like what you were told about it. It is not in September. It does not reach every senior. What it does is this. When SSA is getting ready to allow a new claim for supplemental security income, it now has to request financial account verification and run searches for accounts before the claim is adjudicated and paid, regardless of what the applicant says they own. Saying you have almost nothing in liquid resources no longer skips the check. So if you are on a retirement check and you have already decided this is not about you, hold on, because there is one route that reaches you, and it has nothing to do with your own benefit. If you are a joint owner on a bank account with somebody who applies for SSI, a grandson, a sister, an account you opened years ago for a good reason, and you are not on SSI yourself, SSA's manual presumes the entire balance in it counts as theirs. Your money, counted against a $2,000 limit that was never yours. There is a formal way to undo that, and it has 2 SSA form numbers on it. We will get there. First, what actually changed? Start with the document, because the rumor and the record are two different objects. An emergency message is a temporary operating instruction SSA issues to its own staff. This one went to regional offices, field offices, and teleservice centers. Its title carries most of the story. Expansion of the financial institution. Account verification requirement to all supplemental security income claim allowances, initial claim reopenings, and appeal reversals establishing initial eligibility. Expansion, so something already existed. Supplemental security income, so this is one benefit and not Social Security as a whole. Claim allowances, so this is part of approving a claim, requested before the claim is adjudicated and paid, not on a random Tuesday in your 70th year. Here is what already existed. Since the 1st of August, 2025, bank verification through the system called Access to Financial Institutions has been mandatory for SSI aged claim allowances, 65 and over. For the other initial claims, disability and blindness, SSA generally requested that verification when somebody alleged $400 or more in total liquid resources, all of it together, not one account. Effective the 4th of May, 2026, that split is gone. Verification is required on all SSI initial claim allowances, aged, disability, and blindness, plus reopenings of an initial claim and appeal reversals that establish eligibility for the first time. And here is the clause that changes what happens to a real person, quoted directly. Verification is required, quote, regardless of the claimant's liquid resource or financial institution account ownership allegations, unquote. Allegation is SSA's word for what you tell them. So the check no longer waits for you to declare a balance worth checking. 2 limits the warnings leave out, and each one is somebody's relief. SSA's own note in capitals. Do not verify financial accounts for technical denials. And for post-eligibility situations, SSA's term for people already receiving SSI. Technicians continue to follow existing policy, including that $400 tolerance. So if you are already on SSI, this expansion is not your rule. Your reviews run the way they ran last year, and that is the document saying so, not me. Now, the figure the whole panic is actually about. The limit for countable resources is $2,000 for an individual and $3,000 for a couple. Individual and couple are SSA's own categories, and the distinction earns its place because a spouse's or a parent's resources can be deemed to count toward yours even when that money never passes through your hands. Countable is the word doing the work. SSA's exclusion list runs to roughly 15 categories, and I am going to say 3 of them out loud because these 3 change who is actually over the line. The home you live in and the land it is on, not counted. One vehicle, regardless of value, if you or somebody in your household use it to get around, and that use condition is part of the rule, not decoration. And up to $100,000 held in a qualifying ABLE account for the person that account is set up for. Read that 3rd one again. $100,000 sitting outside a $2,000 limit because of the kind of account it is in. There are many more exclusions than 3, burial funds, household goods, property used in a business, and others, each with conditions attached. The full list is on screen now and linked below, and it is SSA's page rather than my summary of it, which is the point. What matters here is narrower. A person can own their home, drive a car worth whatever it is worth, and hold a substantial ABLE balance, and none of that sits in the count. Adding up everything you own and concluding you are over the limit is an ordinary way to talk yourself out of applying before anybody has looked at the rest of the rules, because resources are only one of them. Two more things about that number, and they are the two that change what somebody does next. First, when it is measured. SSA's page is specific. If your countable resources are over the limit at the beginning of the month, you cannot receive SSI for that month. The beginning of the month, not an average, and not whatever the balance happens to be on the day a letter arrives. I am not handing you away to time a balance, and you should be wary of anybody who does. The point is narrower. When somebody quotes you a number off a random statement and tells you what it means, they are not applying the rule SSA actually applies. Second, what being over actually means, because there is a common piece of false comfort here. For property you can sell, land, a second vehicle, SSA's page says eligibility can begin the month after you sell the excess for what it is worth. For money sitting in an account, there is no equivalent. Cash is not something you sell. If countable resources are over the limit at the start of the month, that month is not payable, and the answer is to get back under the limit by the rules rather than to look for a way to be over. If that was new to you, send this to whoever forwarded you the warning about Social Security checking accounts. They passed on a fear. The exclusions are the part that changes what somebody actually does about it. Now the rule that reaches people who are not on SSI at all, and it starts with how SSA finds an account in the first place. When that verification runs, it does not only confirm what the applicant listed. Under the May instruction, the request has to include the alleged accounts, plus a geographic search, plus applicable relationship-related searches. In plain terms, it can surface an account the applicant never mentioned. And when it surfaces one, they share with you. Here is what the manual does with it. Section SI 0114.0.205, Joint Checking and Savings Accounts. When an SSI claimant co-owns an account with somebody who is not eligible for SSI, the manual says, quote, "We assume that all the funds in the account belong to the SSI claimant or recipient." Unquote. All of them. Not a half share. The whole balance is recorded as the claimant's. So take the ordinary version of that. You are 72 on a retirement check with no SSI anywhere near you. 11 years ago, you put your name on your grandson's account so you could step in if something went wrong. He has a disability, he applies, and the balance you have been keeping in there is counted as his, against $2,000. The presumption changes shape depending on who else is on the account, and it is worth knowing which version is yours. If more than one account holder is an SSI claimant or recipient, the manual splits the money between them in equal shares instead. And if the co-owner is a DMOR, a spouse, or the parent of a child on SSI, SSA records the whole balance as the claimant's and a 0 on the DMOR's page. Different arithmetic, same direction. The money lands on the claim. Here is the route out, and it is the most useful thing in this video. SSA is required to tell the claimant about that assumption and about the right to rebut it. The rebuttal has two halves, and ownership paperwork on its own is not enough for a full one. The first half is ownership on paper, a statement covering who owns the funds, why the joint account exists, who made the deposits and the withdrawals, and what those withdrawals paid for. It goes on Form SSA 2574, information about joint checking and savings accounts, or on Form SSA 795, statement of claimant or other person. SSA asks for the supporting evidence within 30 days, a corroborating 795 from each of the other account holders, that is you, the co-owner, signing your own, plus account records showing the deposits, the withdrawals, and the interest for the months in question. The second half is access, and this is the one that gets missed. To establish that the money is not the claimant's at all, SSA also wants evidence that they can no longer withdraw it. Where only part of the balance is theirs, it wants evidence of one of two things. Either the claimant's own portion came out, or the other owner's funds came out and the account was redesignated. Which is why the practical advice here is not what people expect. Do not start moving money on your own to get somebody under the limit. SSA has a separate rule for that, and it is on the same public page. If you, your spouse, or a co-owner give away a resource or sell it for less than it is worth, you may be ineligible for SSI for up to 36 months, depending on the value of what was transferred. Note that it says co-owner. And remember where this chapter started. SSA begins by presuming that money is the claimant's. SSA decides who actually owned it, but if any of it turns out to be theirs, moving it out for nothing can count as transferring their resource, which is the penalty rather than the fix. Settle ownership through the rebuttal first, then follow what SSA tells you about the account. If the money genuinely belongs to the other account holder, the route is SSA's rebuttal process, which may itself call for that owner's share to be taken out and the account redesignated, done as part of the rebuttal with the paperwork behind it, rather than as a quiet spend down beforehand. Do the boring thing instead. Know whose money is in there, know who has been putting it in and taking it out, and know that those two form numbers exist before anybody needs them. Get both halves right, and the manual is unusually generous about the outcome. If the evidence establishes the funds belong to the other owner, and the claimant can no longer withdraw them, then those funds were not, and are not, the claimant's resources. Not reduced going forward. Undone. Backwards, as well as forwards. That is the kind of thing I go looking for. One circulating money claim, checked against the actual government document, every week. This one turned out to be half true, and the half nobody mentioned is worth more than the half they shouted. If that is useful to you, subscribe. One question left, and it is asked underneath every video on this subject and answered in almost none of them. What if a person simply refuses to let SSA look? It is answered by name in the manual at section SI 00515.001. Permission to contact financial institutions is not a courtesy. It has been an eligibility requirement since regulations in 2003. 3 situations, and each carries a code you can quote back on a phone call. Applying, and you do not give permission, you cannot be eligible. That denial carries payment status code N18. Already receiving, and you refuse or cancel. Benefits are suspended, effective with the month after the month you receive the suspension notice. Code N05. Notice first, and it takes effect the following month. Changed your mind later. Benefits can resume the month after SSA receives permission, and the months without it are not paid unless SSA finds good cause for a DMOR's missing permission. The manual is blunt about it. No retroactive effect permits payment for non-permission months. Good cause exists, and here is the part worth being exact about. It does not excuse your own refusal. SSA develops it only for permission missing from a DMOR, the spouse or parent whose resources count toward the claim, for instance where that person is harassing, abusing, or endangering the claimant, or where the claimant cooperated in good faith and still could not get their permission. There are further exclusions even inside that, so it is narrower than it sounds. And one correction worth making, because it is a common mistake. A representative payee cannot give this permission on behalf of a competent adult. A competent adult gives it themselves, payee or no payee. 4 situations, and one of them is yours. Applying for SSI. Expect the bank verification and give financial permission. It is an eligibility requirement, not a formality, and giving it early keeps it from holding the claim up. Read SSA's exclusion list before you assume you are over. Already receiving SSI. The May expansion did not change your post-eligibility rule, and the permission on your file stays valid. On retirement or SSDI only. Your own benefit has no resource test in it. And sharing an account with somebody on SSI or about to apply, check who actually owns the money and who can withdraw it, and know that Form SSA 2574 and Form SSA 795 are how a rebuttal gets made. So, the change is real. It landed on the 4th of May, and it applies during the approval of an initial SSI claim, and to qualifying reopenings and appeal reversals, before adjudication and payment, not to every senior, and not in September. The nearest thing to a September date in the whole document is the message's own administrative retention date in October, which is SSA's paperwork rather than yours. The rumor was not invented out of nothing. It was pointed at the wrong people, on the wrong date, for the wrong reason. And the real version carries more than the scare did. A $2,000 limit with a longer exclusion list than anybody quoted, and a joint account rule that can make another owner's money count as the claimant's resource unless the presumption is rebutted. One question, and I would genuinely like the answer. When you first heard this, was the real version less alarming than the rumor or more? Tell me which in the comments, because that is the one thing I cannot work out from the documents. This channel is educational. It is not personal financial advice, and it is not tax advice. Nothing here decides anybody's eligibility. The exclusions carry conditions, good cause is specific, and only SSA can apply any of it to a real situation. Confirm anything that matters at ssa.gov or with SSA directly. Check the rule, not the slogan.